Hello, and welcome to the November Hoffman Private Wealth Group podcast. My name is Todd Hoffman, and I'm the certified portfolio manager and certified financial planner, and I'm the founder of the Hoffman Private Wealth Group, where I am the managing director and wealth advisor at Stewart Partners. I'm joined by my co-host, wealth advisor Jenna Makras.
Hello, listeners. Thank you for starting the month with us. October was jam-packed with market action, and November is looking to be another exciting one. But before we get into it, tonight is Halloween. So, Todd, are you dressing up?
No, I think I'm going to hang out on the porch with a glass of wine, and Susan and I will hand out candy. How about you?
Nice. Very nice. Well, Chloe and I are actually pretty excited. We've been planning for a few weeks now. I'm going to be going as Stitch, the Disney movie character, and Chloe is going to be Stitch's cute little pink sidekick, Angel. So I'll give
Nice.
you a little sneak peek.
Adorable. That sounds like fun.
We love to.
I'm sure you guys are going to have a lot of fun.
We will. We love Halloween and we love to do our little combo costumes. So I'm pretty excited about tonight. But enough of that. And Todd, why don't you go ahead and tell us about the markets?
So October's been fascinating with the markets making new highs multiple times. Even Europe and China and Japan are at new highs, according to FactSet.
So why are the markets doing so well right now, especially with the government shutdown and so many headlines about layoffs?
It's a fair question. Despite the noise, there's several strong factors driving the markets higher. First, the Fed cut interest rates a quarter point in October. This has provided a boost in both confidence and liquidity. We've also had a wave of better than expected corporate earnings, particularly in key sectors like AI and technology, where growth's been very strong. On the global side, trade and geopolitical sentiment has improved. And this week, for example, we've seen a reduction in tensions between the US and China. And according to the Wall Street Journal, President Trump's recent trip to Asia has produced new deals involving rare earth materials, semiconductors, and soybeans, along with an agreement to crack down on painkiller imports from China. Finally, we're seeing a big pickup in M&A and IPOs. In fact, Ernst & Young has reported that U.S. M&A activity in September is up nearly 110% year over year, and deal volume's up 41%.
Let's talk about the bond market. I know a lot of clients have been asking about that lately. So how have bonds been performing recently?
Well, according to Madison Investments and MarketWatch, Treasury yields have been trending lower as investors continue to bet on more rate cuts ahead. That's helped push prices on shorter-term bonds a bit higher. That said, while the Fed did cut rates, they didn't signal any additional cuts this year, and the markets didn't love it. Yields dropped right after that announcement. But interestingly, CNBC reported that mortgage rates moved slightly higher yesterday.
That's interesting. What about commodities? Oil's been steady, but gold's really pulled back lately. What's going on there?
You're right. CNBC has noted that oil's been trading in a stable range through October, but gold has sold off after a very strong run earlier this year. I think gold just got ahead of itself, and as investor anxiety faded and people started anticipating more Fed easing, interest in gold just cooled off, at least for now.
Morningstar is reporting that market sentiment is bullish right now, thanks to strong earnings and positive central bank comments. But at the same time, the Conference Board's data shows consumers' confidence has weakened, mainly because of inflation and job market concerns. Why do you think the market sentiment is so strong while economic sentiment feels more mixed?
That's a great observation. And honestly, markets can be funny that way. When people are making money and momentum is strong, investors tend to keep buying, even on the dips. There's definitely some fear of missing out driving behavior right now. That doesn't mean people aren't worried about the headlines. And when companies like Amazon and UPS and Target announce layoffs, it gets people's attention. But you must look at the backstory. During the pandemic, a lot of companies overhired. They were trying to secure talent in any way they could. Then, as productivity lagged with so many people working from home, they kept those extra employees longer than they probably needed to. Now that people are back in the office and AI is driving productivity gains, companies are finally right-sizing their workforce. So while layoffs sound negative, much of it is actually normalization, not a sign that the economy is breaking down. So, in the Halloween spirit, What do you get when you cross a vampire and a snowman?
Oh, here we go. What?
Frostbite. Why don't skeletons fight each other?
Why?
They don't have guts. One more. Why did the ghost go to the bar?
Please tell me.
For the booze.
Okay, back to your day job. Can you break down the sector winners and laggards for the month?
Sure, according to FactSet, tech and communication services have outperformed, led by AI, and industrials and financials caught a bounce on hopes of a rate cut. Healthcare and consumer staples lagged, with lots of reports about weak margin trends. And utilities have been mixed, like we talked about last month, depending on the level of AI capacity investment.
So, in the what could go wrong camp, what's on your list of concerns right now?
Well, markets can get too hot at times, and it does worry me when you see companies rallying that really shouldn't be. It's often a sign that investor enthusiasm is just getting ahead of fundamentals. I'm also concerned about the government shutdown dragging on too long. There are a lot of people who depend on government paychecks, and they still have families to feed and bills to pay. And if this continues, it could start to weigh on sentiment and eventually spill over into the markets, especially if it begins to affect corporate earnings. At the end of the day, we need less political grandstanding and more focus on getting people back to work.
Now, we've been hearing a lot more from clients lately who are a bit uneasy, wondering if the market might pull back now that we're sitting at all-time highs. What are your thoughts on that?
It's a great question, and it's completely understandable. When markets are at record levels, it's normal for people to feel a little cautious. The good news is that there's a lot we can do. Right now, I'm encouraging clients to take advantage of the strong gains we've seen. And I want to reassure everyone, when I start to see reasons for concern, we're going to take proactive steps to reduce risk well before we're asked to. That said, if anyone is feeling uneasy or you just want to review your plan, we have several smart options we can discuss to help you stay comfortable and confident. I'm happy to walk you through these strategies anytime.
Do you have any final thoughts for our listeners?
You know I do. And first, a couple of housekeeping items. It's the end of the year, which means it's time to take your required minimum distributions. This is also a great time to consider qualified charitable distributions directly from your IRA. If you're over 70 and planning to make charitable gifts, please talk to us before you're simply writing a check. We can help you make these gifts in a more tax-efficient way. Also, clients have a lot of highly appreciated positions. And if you're charitably inclined, this might be the right time to look at a donor advised fund or other charitable planning strategies that can create significant tax advantages. And while we're talking about year-end planning, don't wait until the last minute to consider Roth conversions or IRA contributions or other retirement plan contributions. November is the best time to get these done, not December 30th. We can help you handle all of this now so you're in great shape going into the new year. Another item, which is a reminder, one thing that truly sets us apart is that we have a plan for bad markets. That doesn't mean our portfolios aren't going to fluctuate, but our strategies are built to help mitigate losses and manage volatility over time. Our average client has been with us for over a decade, and together we've seen both great markets and tough ones. We're going to see them again, and we're ready. I think the next couple of years will be very exciting with plenty of great opportunities. But if you're feeling uneasy or you want to talk about gifting or taxes or legacy planning, let's schedule some time to talk. We're here to help. And finally, if you know someone who might benefit from what we do, please make an introduction. We hear every day from clients who tell us how much they appreciate our help. Not everyone has a team like ours, but they wish they did. And your introduction could make a real difference for them.
Thanks, Todd. These are all great reminders as the year winds down. And as Todd said, our team is extremely excited to hear from you, whether it's for year-end planning or just to touch base.
Thank you for listening to our November market update. And from our team to your families, we wish you a great month and a happy Thanksgiving. And if you enjoyed our podcast, please share it with a friend.